Hey, what's up, my friend? So welcome to today's training on candlestick patterns. Here's what you'll learn, right? Number one, we'll talk about the biggest reason why traders lose money with candlestick patterns and how you can avoid it. Number two, I want to share with you, right, the May formula. So this is my own proprietary trading formula, right, that will show you how to use candlestick patterns to identify profitable trading opportunities across different markets, whether it's Forex, whether it's stocks, whether it's bonds, right? And also across different time frame. As long as there is sufficient liquidity in the markets, right, this formula, right, you can apply it the same. And finally, I want to share with you a few advanced price action techniques, right, that will help you improve your winning rate. So this is something that I haven't really talked much about, right, and I want to cover it in today's video. So really, you're going to be in for a treat. Okay, so with that said, right, if this is the first time you're watching this video, or for the 10th time, hit the thumbs up button, smash it, right, and subscribe to my YouTube channel. The link, the button is all below. This way, whenever I publish a new training, you'll always be updated. Sounds good? Let's get started. First thing, whenever you trade candlestick patterns, right, I don't want you to make this mistake. What is this mistake, right? Look at this chart. So when a trader, they look at this chart, right, they learn all this candlestick patterns, right? Shooting star is bearish, right? Bearish engulfing pattern is bearish, all right? Hammer is bullish, blah, blah, blah. And when you look at this, right, you can see that over here there's a shooting star. Well, supposed to be bearish, right? Then the market rallied. Another shooting star, price declined slightly before it break out higher again. Then over here you have somewhat of a bearish candle, a bearish engulfing pattern. Price moves slightly higher, then it rally again. Over here you have something like a dark cloud cover. Price barely move down lower before it breaks out higher again. So you can see that this, right, over here, the mistake that many traders make is that they look at these candlestick patterns and trade them in isolation. They simply study a candlestick pattern, find out what's the meaning behind it, they memorize all this meaning and just trade them blindly. And when you do that, right, you can see that you're going to suffer loss after loss after loss. So the first lesson that I want to share with you right now is this. Don't trade candlestick patterns in isolation, right? That is a losing proposition. So now you might be wondering, okay, Rainer, I shouldn't trade candlestick patterns in isolation. So what now? Well, what you want to do is apply this, right? The May formula, right? If you apply this formula, I can almost guarantee, right, that when you trade candlestick patterns, right, your results will be improved. So what is this May formula? Let's get started. Number one, M. It stands for market structure. So generally, when you trade the markets, it can be broken down into three main categories. In an uptrend, a downtrend, or range. So the market, let's say in an uptrend, it looks something like this, right? Higher highs and higher lows. Downtrend is lower highs and lower lows. And range is just something like this. Okay, range where the highs and lows, right, are pretty much around the same area. So now, once you've identified the market structure, it doesn't mean you buy immediately. For example, let's say the market is in an uptrend at this level over here. Do you want to buy it at this point? Not quite, right? You don't want to buy just because the market is in an uptrend. You don't want to sell over here just because the market is in a downtrend. Why is that? It's because you want to look at number two, area of value. You want to be trading from an area of value. So for example, let me give you a few examples of area of value. So let's talk about an uptrend. So market is in an uptrend. A few possible area of value could be this one over here, right? Where price retests previous resistance, now becomes support. That's one possibility, an area of value. Alternatively, right, the price can also retest previous swing low or previous support. So something like this, uptrend, market then does a slight consolidation and retests this previous area of support. This is another area of value. And also, another variation of it is that area of value can be in the form of a moving average or trend line. So market is in an uptrend, okay? And if you pull out, let's say, the 50 MA, you notice that the price tends to, respect this moving average over here, right? Usually in a healthy trend, right, it tends to respect the 50 period moving average. So let me share with you a few examples, okay? So the first one is this one here. You can see that here. This is pound yen. You can see that this over here, market is in a downtrend. Where's the area of value? The area of value is over here. Okay, previous support, breaks down, right, becomes previous support, becomes resistance. This is an area of value. Another example, it's this one here. Okay, this is the 30-year treasury bond. Okay, you can see that in this case, right, it's a healthy trend, and the market tends to respect, right, the 50 period moving average, which is this blue line over here, the area of value. Okay, area of value. And this one is over here, area of value. So remember, I say area of value, not line of value. So you're dealing with an area on your chart. And let me just give you one more example. I think Bitcoin is pretty... Okay, so if you look at Bitcoin, another area of value to share. This one over here. Price broke out of this highs, right? Almost retest this previous resistance turn support. Then again, right, it broke out above this highs, comes back, almost retesting this previous resistance turn support, and now it come back down, retest right now is back towards this area, right? This support area. Then it tested a few times before it finally, broke down. So you can see that in an uptrend, there are numerous ways to define your area of value, okay? And I want you to be aware of it. So you can see over here, right, area of value, the most common ones are usually support resistance, moving average, trend line, okay? And downtrend is just the opposite. So now, you have got your market structure, your area of value. What's next? This is where we move into the entry trigger. So you can see that, when you trade candlestick patterns, you don't just dive in straight into candlestick patterns, right? Hammer, shooting star, ding, ding, ding. No. You look at the context of the market before you look at the candlestick pattern. So we have covered a couple of things. Market structure and area of value. And finally, now we look at the entry trigger. So this is where candlestick patterns shine because they are useful, right, to act as an entry trigger. So an entry trigger is simply like a signal, right, to get you into a trade. Okay, and a couple of things you want to pay attention to is like for bullish patterns, I believe the most common ones you encounter is the hammer and bullish engulfing pattern. And for bearish patterns, right, you will usually encounter the shooting star and bearish engulfing pattern. So these are the patterns that you saw earlier when I talk about the mistakes that traders make. So just to walk you through, right, for those of you who are not familiar, so for a hammer, this is where the price open at this level. Then the sellers, right, they came in and took control and pushed the price all the way down lower near this lows. Okay, at this lows. And finally, the buyers said, now, okay, this is low enough, right? You're not going any further, right? Let me just push the market back up higher. And the buyers, they came in, they pushed the price back up all the way up back towards the highs, and finally closing near the highs of the day, or rather for the time period. So this is how you get a hammer. And basically the story of a hammer is sellers came in, they took control, and suddenly the buyers, right, came in and pushed the price all the way up higher, and smashing the sellers to one corner. So bullish engulfing pattern, it's a similar story. You can see over here, right? Price open here and then close near the lows of the time period. Then the next candle, the buyers open near the lows, right? The sellers try to push the price down lower near these lows, but that's as far as they could go before the buyers went all the way up higher, right? Pushing the price, closing near the highs over here. So you can see that again, right? This tells you that the buyers are temporarily in control. So for bearish patterns, it's just the opposite. I'm not going to treat you like an idiot, right? You probably know where I'm going to come from. This simply tells you that the sellers are in control, and what you're seeing is actually, price rejection of higher prices on your chart. And this over here, right, are useful, right, as entry trigger to enter a trade. I'll share with you a few examples later on, right? So bear with me for now. And the last component of the May formula is exits. Okay, exit when you're wrong. So basically where you set your stop loss. And exit when you're right. Where do you take profit? So there are many ways you can go about, setting your stop loss, setting your take profit level. So I'm just going to go with an approach, right, that has worked well for me, right? So there are many ways to tweak this. I'll leave it to you to explore, to validate, to verify it for yourself. But right now, I just want to share with you an approach, right, that has worked well for me. So when it comes to stop loss, okay, remember, okay, you do not know this yet, but we will be trading from an area of value. I'll share with you a few examples later on. So when you set your stop loss, you want to set your stop loss away from the area of value. You don't want to put it smack in the area of value, because that kind of defeat the purpose, right? What's the point of trading from an area of value if your stop loss is smack in the area of value? So let me give you an example. Let's say market is in a range. Okay, it comes down near these lows, right? Then it breaks out higher, closing above above support. Okay, so when you set your stop loss, okay, where do you set it? Right, let me just highlight this in red so you can see it. Okay, so you don't want to set your stop loss at this level. You don't want to set it here, and you don't want to set it here. Why? Because remember, we are trading from an area of value. An area of value is where in this case, right, potential buying pressure could come in and push the price up higher. So if you put your stop loss over here, that is a sell stop order. It's like saying, you want to sell at this price, right, to get out of the trade, which doesn't make sense because this is an area where potential buying pressure could come in. It's an area on your chart, and you want to give the trade room to breathe. You want to give it enough room to wiggle so you don't get stopped out too early. So my approach, right, usually is I set my stop loss right away from the area of value, usually somewhere about here. Let me just change this to blue so you can see where I usually do it. Somewhere about here, and the exact level, right, is using the average true range indicator, 1 ATR below this low. If you do not know how to do it, right, I'll share with you an example later on as well. So usually my stops is over here, all right, and if I'm shorting near the highs of resistance, my stop loss will be somewhere here. Right, I can see that there's a buffer, a distance away from the area of value. So this is how I set my stop loss. Now, what about exit when you are right? Where do you take profit? So let me just share with you, right? So there are many ways you can do this, depending on your trading goal, whether you want to capture a swing, whether you want to ride a trend. Okay, so generally, if let's talk about swing trading, right? If you just want to capture one swing in the markets, you usually want to do it before the opposing pressure comes in. So again, an example, let's say market is in a trend, in a range, okay, and you bought near the lows over here, okay? Ask yourself, right, if you're buying near support, where would selling pressure come in? Well, chances are selling pressure is going to come in somewhere near this area of resistance, right? Somewhere about here. So when you take profit, right, you just want to exit, right, just before this highs over here. So in other words, right, capturing a swing, you'll capture this portion of the move. Just this one swing. If the market swings up higher, you'll exit the trade capturing this one swing over here. Okay, so this is where you exit your trade, just before opposing pressure comes in. Okay, so right now you've learned the May formula, right? Market structure, area of value, entry trigger, and exits. So let me walk you through a few examples, right, to kind of encapsulate, right, what you have just learned. Okay, first one, let's look at pound dollar. So pound dollar, okay, so you can see over here. Look at this chart. I mean, all this I'll cherry pick, right? These are trades that I trade them. They are cherry pick, right, to explain the example. There will be winners, there will be losers, but bear in mind, when you trade them on demo first, okay, there will be losers. So don't get shocked at, Rainer, that's a loss, right? Of course, there's going to be losses, right? Trading is no 100% thing. Okay, so first thing first, right? Pound dollar, looking at this chart. What do you see that in this market? What's the trend? Well, the trend is down. Okay, so that's the first thing, right? Let's talk about market structure, M. Trend is down. Second one, area of value. Where is the area of value? Well, I see this one over here. This area of resistance is an area of value. So area of value, let's call it R, resistance. E, is there an entry trigger? So from what I'm seeing over here, this looks like a bearish engulfing pattern, telling me that the sellers are temporarily in control. So yes, we have a entry trigger, right? Let me just call it B, right? Bearish engulfing pattern. Okay, so exits, right? Let's talk about the exits now, right? Let's call it no space. Let's do it here, E. What about your exits? So first, let's talk about stop loss. So remember, I don't like to set my stop loss, right, just above the highs, because the price could just, rally up higher and then collapse down lower. And if I just set it above the highs, I would get stopped out. So what I usually do is, again, right, ATR indicator, just go to indicator, pull out ATR, click on this, right? I usually have a 20 period ATR, so I'll just, go with my standard default. And it's usually SMA. But trust me, it's not going to make much of a difference, whether you follow my settings or not. And you can look at this, right? Right now, from the looks of this chart, the ATR is about 80 pips right now. Okay? So this tells you that historically for pound dollar on the daily time frame, right, over the last 20 days, it has moved an average of 80 pips. So what I want to do is to find out what's the high over here. Let's say the high, the value is X. I add on 80 pips. Let's call it 80 pips, P, right? And let's say the value I calculate is Y. So my stop loss would be somewhere over here, right? Let's call it Y, right? So this is my stop loss. Basically 80 pips, right? From this highs to this level. That is my stop loss. Okay, so that is where I set my stop loss. Now, the other question is, where do I exit the trade? Exit my winning trade? Well, if you recall, I mentioned that when it comes to exiting your winning trades, you want to exit before the opposing pressure comes in. And where would opposing pressure come in? If you ask me, I would say this swing low is a level that you want to be aware of where, potential buying pressure could come in. This is like a swing low, an area of support. So in terms of taking profit, right, you want to be looking at this level, right, to take your profit, right? So just capturing this one swing down lower over here. Okay, this is just this one swing. Okay, so this is an example on pound dollar of the May formula. Moving on, let's look at another one, Aussie yen. Okay, so again, this is very similar to the pound dollar one. You look at this market again. What is the market structure? Let's look at the M. Let's call it MAEE. Okay, market structure is down, so you want to be selling. Area of value is at resistance, right? Price right now is at area of resistance, so it's resistance. Entry trigger, you have somewhat of a bearish engulfing pattern. Let's call it a B bearish engulfing pattern. Right, if it's hammer, just put H. Shooting star, just put S. Whatever suits you. And exits, right? Again, right, the same technique I share with you, right? I usually set it 1 ATR above this highs, and I like to exit my trade right before opposing pressure comes in. So if you ask me, right, this level over here, this swing low, is where potential buying pressure would come in. And a mistake, right, that many traders do, right, is that they like to set their TP level, their take profit level, below or smack at this level over here. Right, you're trying to, squeeze every damn pip out of the markets. Remember again, right, we are trading from an area of value. The market moves from one area of value to the next. When you're dealing with an area, there's a possibility that the market may not retest this level. It might just come down close to here and then you reverse higher. And if you try to squeeze, the additional 2-3 pips, right, you might see your winning trade become a losing trade. So don't be too greedy, right? Give the market some buffer, let the market have a little bit of small change, right? Why not, right? So usually I set my targets, right, a buffer above the highs over here. Okay, so I don't really go with ATR for this. Right? I just use a rough estimation. Usually, where the price tested the level many times, I just set it a small distance above it, right? If you want, you can use 0.2 or 0.3 ATR to help you kind of quantify the take profit level. But for me, I just usually just set it a distance before the obvious market structure level to take my profit. Okay, so in this case, it'll be somewhere here. Okay, so there you have it, right? This is your exits as well, the May formula. Okay, so in this case, it's not important to see the result of the trade, right? Because again, I want you to go and verify this formula on your own. Don't just trust what Rainer say. As I like to always say, right, never trust anything, always verify everything. That's the way to succeed in this business, right? You can't just take my word for it and say, oh, this works, and you do it on your own. Because if you do not do the work to verify, to validate a trading concept or strategy, when the drawdown comes, right, you won't have the conviction to continue trading it. So this is why you have to do your homework. You have to do your own verification, your own validation. No one's going to help you. Okay, so do the work. Don't expect to be spoon-fed. That's how traders lose in trading, because they want to be spoon-fed. And I don't want that to happen to you. So please do the work. Moving on, right, let me share with you another example, right? The S&P, I think, is quite a good one to share. Okay, so this time around, let me just get rid of the ATR since you already know how it works. So the S&P, right, you can see that it works on different time frame. Let me share with you the 4-hour time frame. Okay, over here. Okay, so you look at this, right? Again, same thing. In this case, what is the trend of this market? So this one is it gets a little bit tricky, because if you look at this just based on this chart, you might think that, okay, the trend is down. Okay, but this is where your concept of multiple time frames, or or rather zooming up and look at the big picture, it helps. Because if you look at this, right, this is actually somewhat in a uptrend in a higher time frame, and you look at this right now, it's more of a range, if you ask me. So to me, right, I am still comfortable, right, looking to buy near this lows over here, because if you see later on a higher time frame, the daily time frame, the market is actually still in an uptrend. So higher time frame in an uptrend, market is at this area of value. Okay, this area of support. Then you have this false break over here, a hammer. Okay, and again, right, this is the May formula: market structure, area of value, entry trigger, and your exits again. Stop loss, you already know what to do, right? Let's talk about where is a level that you want to consider exiting your trade. So a couple of levels here that I'm seeing. One is this one over here, previous swing low that could become resistance, and the second one is this one here, this area of resistance. So again, don't try to nitpick every single pip or tick in the market, right? I would say you can have 2 targets here, one possibly at this level, and maybe one just before this level over here, right? So give the market some tips, some a little bit of something. So this is another example. Another one here. Okay, so this may or may not be a winning or losing trade, but you can see again, right? Let's talk about market structure. MAEE. Okay, market structure is up. Area of value at this area of support. Okay, area of support right over here, area of support. Okay, so we'll just call it S. Entry trigger, you have well, it's not a hammer, it's not a bullish engulfing pattern. I'm not exactly sure what is the exact candlestick technical definition, but you can see that there is buying pressure coming in, right? There is a price rejection of lower prices at this this area over here. Okay, so that is an entry trigger as well. Okay, let's call it I don't know what you call this. Let's call this question mark there. Yeah, since I do not know what's the technical term you want to call it. I know. Let's call it price rejection, right? Since yeah, we're just simply trading price rejection in the market. PR. And your exits, right, again, stops you're probably familiar with. And in terms of exits, I would say this over here again, right, is a possible level you want to consider exiting your trade. And the second target could possibly be just below this area of resistance somewhere here. Okay, in this case, you can see that the market pretty much just hit this this first target and then it collapsed lower. So depending how you manage your trades, right? So trading is not just entries and entries, right? Depending how you manage your trade, this could be a winning or losing trade. So let's have a look at a couple of more examples, right, before we move on. Another one, right, is crude oil. Okay, so crude oil. Okay, let's go to the daily time frame. You see that over here, at here. Okay, so again, what is the market structure at this point in time, right? Market structure MAE. Market structure, if you ask me, it seems to be in a range at this point in time. So let's call it R. Area of value, price is at this area of support. Entry trigger, it seems like a bullish engulfing pattern. I call it B. Exits, alright. So again, stop loss, right? Just 1 ATR below this low. In terms of exits, right, where I foresee opposing pressure could come in is below this this low, where previous swing low could become resistance, and possibly a second target is somewhere here. Okay. So again, right, set your targets before these levels, just before it. In this case, market, you can see that it flirted around with your entry, mess with your psychology. But if you have a plan, right, a plan in place, you know where to enter, where to exit your trades, right, you will hold on to the trade and eventually, you know, get to the target that you have determined. Okay, one last example. Okay, so I think so far I shared with you it's all winning trades, but that's not reality. So here's a trade for you to look at. So this one, right, is a very okay. So again, this one, right, if you look at this at this point in time, the market might seem like to be in a range, yeah, but it's true, right? It's in a range. Actually, it's between these highs and these lows over here. So market structure M, let's call it M, is in a range. Area of value at this area of support, right? This is the area of support over here that I've drawn. Entry trigger, you have a nice strong hammer that rejected lower prices, so you go long. And exits, right, if you ask me, this will be a first possible target that you want to look at, right, where previous, you know, swing low could become resistance. In this case, it's a losing trade as the market just, you know, collapsed lower and you probably got stopped out. Okay, so I hope this few examples, right, give you a good insight into the May formula. So now let me share with you a few of my secret sources, right, before we conclude today's video. Number one, power move into an area of value. So whenever you trade this type of, you know, reversal, this is in essence, right, trading price rejection of an area of value, reversal, okay? You want to have a power move into a level. So if you look at my earlier examples that I shared, right, most of the trades, right, they all look something like this. Price, let's say you want to buy, it comes straight strong into a level, very strong momentum, large bodied candles, right, into a level. Then you look to buy at this area of value, right? What you don't want, right, is to see the market come down into a level in a very choppy, stair-stepping manner. Let me just illustrate this to you. So what you don't want, right, is if the market does this. Let's say again you're trying to buy, and the market comes down in this manner, lower highs and lower lows. Now, this is the type of price action that I don't want to trade. Why is that? Because if you recall our exits, right, we typically exit before opposing pressure comes in. And if you buy, let's say at this area of value, where will opposing pressure come in? Well, there's a lot of places where opposing pressure could come in, right? Because at this swing high, this swing high, this swing high, this swing high, or even this swing high, you can see that there's a lot of areas, right, or levels on the chart where opposing pressure could come in, and that reduces your profit potential. So this is why I don't like to trade when the market comes into a level, into an area in a very choppy, stair-stepping manner, like, you know, like lower highs into support or higher lows into resistance. I don't want to trade those reversals. I only look for a strong power move. So in case you do not know what's a strong power move, right, just a quick recap. Look at this, right, strong power move into a level, strong power move, right? And let's see, we talk about the crude oil one as well. Again, right, strong power move into a level. Usually the power move the candles, right, they are just one colored candles, and the range of the candles, the body, they are pretty large. So that's what I mean by a strong power move. Power. Okay, another one, it's false breakout followed by strong price rejection. So what I like also to see is that the price breaks out of a key market structure and then get rejected strongly. So let's say like something like this, okay? So let's say price breaks out of resistance and it gets rejected strongly and closes back within the range. So I like to see a false breakout, because when price breaks, in this case, breaks out of resistance, right? Above this highs, traders, right? Momentum traders will look to buy the breakout. So they are long. And when the price makes a sudden 180-degree reversal, now this group of momentum traders, this group of breakout traders, they are now trapped because they buy a breakout and the market does a sudden reversal and they are like, oh, crap, in the red. Again, why does this always happen to me? Why? Well, it's because they buy breakout after the price has made a power move, okay? So I like this, right? When price makes a false breakout followed by a strong price rejection, because breakout traders are trapped, and as the price, let's say it reverses down lower, it will hit their stop loss, right, which would fuel further selling pressure in my favor. So I also like to see a false breakout followed by strong price rejection. And in fact, I think the examples that I've shared with you earlier, right, they are all mostly false breakout of a key level as well. And finally, right, the last tip I have for you is limit order. Sometimes, right, where the price rejection it's so strong, or you miss the move altogether, right, and if you enter the trade, it's too late. The risk to reward doesn't make sense. So what now? So what you can do is use a limit order to see if you can get filled at a better price. So let me give you an example of the limit order technique. So let's say, right, for example, let's say over here, you notice that there is a price rejection at support, okay? And the market has really now rallied near this highs over here. If you were to buy right now, you'll be buying near the highs. Let's say your stop loss is 1 ATR below this low, so let's say it's somewhere here. Okay? And you can see that your stop loss is pretty darn wide. If you buy right now, right, it's only going to be a short while before you encounter, selling pressure at this level. So what can you do? So one technique to share with you is to use a limit order to see if you can get filled at a better price and thereby improving your risk to reward on the trade. So let me just share with you, right? Let's say instead of, buying at this highs, you tell yourself, you know what? I'm just going to place a limit order, a buy limit order, and see if I can get filled at a better price. If I get filled, great, right? I know my risk to reward on the trade will be improved. If I don't get filled, it's okay. I'll move on to something else. So in this case, you can, set your limit order, let's say below this lows of this candle somewhere here. Okay. And from here, you can see that now if your entry is here, your stop loss is still at this level. Your risk, right? Let's call it your risk, right? Is now, in terms of, dollar terms, your risk is reduced. Okay. And your risk to reward is now, improved. And one tip to share with you is that whenever you set your limit order, you want to place it at market structure where the price would have difficulty going through. So this is where you can use multiple time frame to assist you with it. So let me just go down to, let's say, 4-hour time frame and to share with you what I mean. So in this case, okay, so this is the portion here where we saw earlier on the higher time frame. Let me just share with you, right? So this somewhere about here, I believe somewhere about here, right, is where you saw that buying near the high. So when you want to use a limit order to get in at a better price, if you notice that, let's say there is this previous market structure over here, previous resistance that could act as support, or if let's say when you look at the chart, right, there is another of this market structure here over here, okay, what you want to do is to place a buy limit order at this market structure. Don't try to place a buy limit order like, let's say, over here, because the price has to break down this market structure and this market structure before you get filled. And by the time we break so many market structure, probably, right, probably it's going to be a loss, okay? So if you think about this, right, if the trade should work, right, this market structure that you see over here on the lower time frame should hold. So what you want to do is to place, let's say, a buy limit order at this level. And if you do get filled, right, you would see that, you're actually buying at an area where buyers could potentially come in to support these higher prices. So this is a good area, right, to consider placing your buy limit order. I would say this is the one that I will most likely place at this. Unlikely I'll place it over here because the price would have to, break this level over here. And if the price doesn't break this level, and if this level holds, right, and let's say it reverse from here higher, right, I would have missed the trade because I was being too conservative and place a buy limit order over here. So usually what you want to do is go down to a lower time frame and observe the market structure. Where is a logical market structure where I can place my limit order to get filled on the trade? And the market structure would help you, support that so-called bias of your trade. Okay, so this is how the limit order technique works. So those three are my secret sauces, and let's do a quick recap before we conclude today's video. Number one, never trade candlestick patterns in isolation, right? You have seen why. If you do it, you find that, you lose pretty often. Number two, right? The meat of today's video is simply the May formula. And if you think about this, right, the May formula is simply answering this question. What should you do? Market structure tells you what you should do, right? Whether the market is in an uptrend or downtrend. If market is in an uptrend, you want to buy. Market is in a downtrend, you want to sell. So the M of the May formula tells you what you should do. The A of the May formula is the area of value. It tells you where to buy or where to sell. Right? Where to buy and where to sell. You want to be buying at support, you want to be selling at resistance, moving average, trend line, whatever, your area of value. The area of value tells you where you should be trading. And the E, right, the entry trigger tells you when to enter the trade, right? The candlestick patterns, right, is the entry trigger that tells you when to enter the trade. And finally, right, the exit also tells you when to exit the trade if it goes or in your favor or against you. Okay, so this is the May formula. Hopefully, this is something that I want you to go out there, test it, verify it before you trade with your own real money. Please do that. And finally, we talk about the secret sauces, right? I look for a strong power move into market structure because it improves my profit potential. Number two, I like to see a false breakout followed by strong price rejection because I can then trap, right, the breakout traders who bought the breakout. Okay. And finally, limit order, right? If the price has moved too much at your desired level price, you can have a limit order and see if you get filled to improve your risk to reward on the trade. Okay, so this is the candlestick patterns training video, and if you've enjoyed today's lesson, then this is something that you'll enjoy even more. I have this trading guide for you called the Price Action Trading Ultimate Guide to Price Action Trading. Just go down to my website, tradingwithrainer.com, click this orange button, and I'll send it to your email address for free, right? You'll learn how to better time your entries and exits. We'll cover, more price action trading concepts and much more, and it's free. So do it right now. Go to my website, sign up for it, and I'll send it to you, to your email. And with that said, I have come towards the end of this video. If you've enjoyed it, hit the thumbs up button, subscribe to my YouTube channel. The link is all below, and I will talk to you soon.